What's up, guys? I hope you're doing well. So, I was reading a newsletter, or I guess an essay, technically, from one of the Fed presidents, specifically the Minneapolis Fed president. Um, and this was published May 6th, 2020. Basically, about how, e- everyone's been paying attention to how the Fed has been raising interest rates and tightening monetary policy and blah, 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 right? So, basically, he's saying it's like, are we close to neutral? Meaning, like, to where the rates and such, monetary policy in general is neither accommodative or the opposite of that. I forget what the term they use is at the moment for some reason. But anyway, we'll go straight to the screen share of this article. Make it big enough. There we go. So you guys can see it better. Anyways, okay, so an important question for monetary policy makers is what policy stance, including current setting of the federal funds rate, the current size and composition of the Fed's balance sheet, and the expected paths of Fed funds and balance sheet, represent neutral, neither stimulating nor restraining the economy, right? And so, where exactly does monetary policy kind of play, right? And so, basically, in their recent summary of economic projections, which the Fed does, I think it's quarterly. I don't remember exactly the frequency off the top of my head, but the participants in the FOMC estimate the longer run level of the Fed funds rate, um, which, if you don't remember, is the overnight nominal interest rate, right? And basically, he's comparing it to. Okay, I'm just going to read this part verbatim. That is the overnight nominal interest rate that best represents neutral in the longer run, once the various shocks that are hitting the economy has passed. And they can't observe this directly, they can only estimate it. It's not something that's like you kind of just you realize when you're there when the economy is kind of, I don't know if I'd say stagnant. I'd assume it'd be kind of similar to their inflation target, right, where it's 2%. And even here, they say, like he says, his estimate is 2% for Fed funds. And then the FOMC participants were ranging from 2 to 3%, right? Um, and the reason why this is important is most economists argue that it is not nominal rates that drive economic activity, but real rates, which is nominal rates less inflation, right? And so, kind of like instead of just looking at the nominal prices of things, it's more of like the actual value, like how much can your money buy, right? Which is a concept I've gone over quite a few times in other videos and posts and such like that. So, um, basically, here's a little chart of kind of the difference, right? So we have headline PCE inflation, and as kind of a reminder, the Fed prefers the PCE number, which is what is it? Um, not necessarily the CPI, right? It's just kind of news, and I guess more mainstream people choose to use CPI because it's like different weightings and it's technically different. Measures different things, obviously, because the CPI is, I think, for this past month was at 8.3%, and then PCE showed like 6.6 or something. But anyways, this black line here that's highlighted right now is the PCE, and then you have the nominal Fed funds rate. As you can see on the very end, they're starting to uptake right here, where it was at, according to this chart, it gets 8 basis points, and it's now up to 83. And then you have real Fed funds, which is the difference between the two. And you can tell that real Fed funds right now is negative 6.39%, right? And so this is kind of what they're talking about. So it's like where it's the real rate that really matters. And his point is that this actually isn't correct, according to him. And he says, while he agrees real rates are more important than nominal rates in driving economic activity, it's the long-term real rates, say 5 to 10 years or longer, rather than overnight rates that influence the business and consumer demand for credit. And so, like, remember, Fed funds is like an overnight funding market, right? It's very short term. It's not like overnight repo, but it's much shorter term, right? It's supposed to be kind of their way of influencing short term interest rates. So, more of like the T bills arena, um, going out maybe a few months, right? And the much more shorter term. So, they are considering the interest rate. They will this is in terms of the consumer or the businesses, right? So the consumer or business, when they're considering the interest rate they'll have to pay for a mortgage or some loan, um, normally those loans are longer term, like 10 to 30 years or so. So basically, in his view, long-term rates are far more important than short-term real rates in driving economic activity, and they should be looked at to assess if policy is stimulating or restraining, right? So basically, the whole like, is monetary policy accommodative or restraining the economy should be based off of, the longer term rates, like 10 to 30 years or so, rather than short term rates, according to this, or according to his point of view, I should say. And kind of his point on this, where he has the second chart, which is the 10-year TIPS yield, which TIPS are, it's like Treasury Inflation Protection something securities, probably securities. But it's like basically the yield on this kind of reflects, I guess, supposed to help protect against inflation, hence the name. But it shows that long-term real rates have risen quickly over the past several months. In fact, they have risen even faster than they fell in spring of 2020, when the FOMC cut the Fed funds rate to essentially zero and launched a massive quantitative easing program to support the economy. So I'm assuming this is where he's talking about the massive increase, where it goes from about negative 1%, it looks like at the bottom, up to not even 20 basis points, according to this chart. And so it's a 1.2% increase or thereabouts. And then he asks, how is that possible given that we have only raised the Fed funds by 75 basis points and haven't actually begun shrinking their balance sheet? Right. So it's like, why is this increase so much? And basically, he goes into that it's due to forward guidance, right? He says the FOMC has signaled where policy is headed in the future, and markets have adjusted in anticipation for these policy moves, which is right here, right? And so he says this is due to the FOMC's strong credibility with market participants, and that they take. Okay, I'm going to read this part out loud, like verbatim, because I kind of think it's funny, or it shows a bit of a the mindset in a way. So because the FOMC has strong credibility with market participants, they take our forward guidance seriously, as they should, right? And so it's one of those things too. It's like, how many times has like the Federal Reserve, like changed their mind or done the wrong thing or been wrong about something or whatever, but they should definitely take their guidance seriously, depending on what they do, right? And of course, naturally, at the very end of this, kind of as a I guess a corollary, you have the typical, like, we will need to observe incoming data over the next several months to determine this. All right. As with everything you get with the Federal Reserve or typically policy in general, it's like, we got to wait. But anyways, so let's see. Says the 10-year real rate was about 0% in March of 2020, and today it has returned to about 0% after falling negative 1% during March 2020, at the height of the Fed's monetary stimulus, right? And so He says one approach is to look at forward real rates, which allow for the effects of shocks to have passed. The following chart shows 5-year real rate 5 years forward, which is one such proxy. You can see in it has been Wow, you can see in it has been declining over the past 20 years. Okay. You can see in Yeah, um I know I'm not the best at, using proper grammar all the time, but I'm pretty sure that's wrong. Or at least difficult to read and could be said better. But anyway, here's the chart. 5 year forward, tips yield shows it's generally going down, hovering around 0% ish, kind of looks range bound. Um, so yeah, and then basically he goes on for multiple things that he thinks we are close to neutral, this kind of neutral Fed funds to where it's no longer accommodative or restraining. Um, and so basically he says that the Fed just has to follow through with their forward guidance, do their do the federal fund rate increases and balance sheet reduction that they've already signaled, is what he says is the minimum they need to do. And then they'll need to see whether the supply issues that have contributed to high inflation begin to unwind, or if the economy is in a higher pressure equilibrium. And this part I actually kind of agree with, and this part makes a lot more sense. If supply constraints, I cannot talk this morning. If supply constraints unwind quickly, we might only need to take policy back to neutral or go modestly above it to bring inflation back down. If they don't unwind quickly, or if the economy really is in a higher pressure equilibrium, then we will likely have to push long-term real rates to a contractionary stance, to bring supply and demand into balance, right? And I guess just kind of not really even a side note, but something that's worth saying is all of this monetary policy stuff, this has essentially nothing to do with supply. I mean, they print bank reserves, not oil, or insert your commodity here, or goods and businesses and such. It's like they basically can only influence like aggregate demand, right? And I guess I've there's somewhat of an argument to say that basically by making lending more accommodative and so on, or monetary policy more accommodative, they can increase the amount of supply, um, in general, by basically giving the businesses and such the ability to produce more goods and services, right? By being able to borrow more money and go further into debt and so on, they can actually be able to like produce more, right? And use those for proper business practices, which is assuming that that's what they actually use it for, which is a completely different discussion. But it's also like with supply constraints, as we're talking about now with supply chain issues, according to this, is they don't them making monetary policy more accommodative does not change that whatsoever, right? Not really. Doesn't really fix the problem. Um, yeah. But forward guidance and the committee's strong credibility and market participants have resulted in a withdrawal of monetary stimulus even faster than they added it back in spring 2020. And then look at mortgage rates. And he's bringing that up as they just spike up. Which this is one thing I said would be interesting to watch. I did this video back in January when I was going over the monetary policy report. Maybe it was early February, where it was like we were just now starting to see this uptake, right? And then I was like, wouldn't it be interesting to see, like, does this level off and kind of continue down here, like as if it's range bound, or if it just takes off? And well, we have our answer, at least for the past few months, because it's gone from essentially close to the bottom-ish, all the way back up to its peak, at least in this range, from, we'll say, 2018 to 2022-ish, right? So 5 years in there, and it's already back well above it. Which, I mean, like, obviously we're going to ignore when interest rates were a hell of a lot higher than this era in time, back in like I believe it was the 70s, late 70s, early to mid 80s or so. I don't remember exact dates off the top of my head, when interest rates were a lot higher, say like in the teens, if I remember correctly, for mortgages. Maybe even closer to 20. But I'd have to look at a chart, right? And so, again, they have to follow through with their forward guidance, because, should always focus on forward guidance, because, I'm just going to highlight it again, maybe in a different color. Oh, it just changes the whole thing. Never mind then. Because the FOMC is so credible, and they should always be taken seriously, according to him. But yeah, that's pretty much all I got on this one. I'm just kind of thinking through, the differences and such. But anyways, I hope you guys have a good night, and I'll see you on the next one.